Happy Tuesday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Today's episode will be very heavily focused on US-China dynamics. Tensions between the United States and China have reached a new height after President Donald Trump signed an executive order doubling tariffs on Chinese imports to 20%. Effective midnight, March the 4th, today. This move brings the total US trade-weighted tariffs on Chinese goods to nearly 38%, a level comparable to a potential congressional repeal of Permanent Normal Trade Relations, PNTR. The White House confirmed that these new tariffs follow an additional 10% increase in February. China's Ministry of Commerce quickly condemned the move, stating it, quote, firmly rejects, end quote, the new duties and will take countermeasures. The ministry urged Washington to withdraw the tariffs, warning that they would harm US-China trade relations. Beijing has not yet outlined specific retaliatory measures. The state-run Global Times quoted an anonymous source saying that countermeasures could include tariffs on US agricultural and food products, as well as non-tariff restrictions. As we've said over and over again, however, due to the massive size of China's trade surplus with the United States, the US deficit with China, in the realm of trade, is the much more vulnerable party. Previous Chinese responses to US tariffs have included raising duties on certain US energy exports and placing 2 American firms on an so-called unreliable entities list, potentially limiting their business operations in China. Analysts expect that China may once again target key US exports, such as soybeans and energy products, which together accounted for over $40 billion in US exports to China in 2023. Meanwhile, Beijing has been assessing President Trump's trade strategy through informal diplomatic channels. According to the US-based The New York Times, a delegation led by former Chinese ambassador Cui Tiankai met with US think tanks in Washington, advocating for China to be treated as an equal partner and warning of potential repercussions, including withdrawing cooperation on fentanyl-related law enforcement. As tensions rise, both nations brace for further economic fallout in what appears to be an intensifying trade war. Markets are nervous too. The news that the US president is doubling down on tariffs on Mexico, Canada, and China sent bonds up and stocks to their biggest loss of the year, the S&P 500 down nearly 2%. Next up, is China finally beginning to see some signs of limited stabilization in their economy? While it's too early to tell, we do take note of 2 updates. First, China's real estate market exhibited signs of stabilization in February, with residential sales posting a slight increase amid continued policy support. According to preliminary data from the China Real Estate Information Corp, the value of new home sales from the country's 100 largest property developers rose by 1.2% year over year. This improvement follows a 3.2% decline in January, suggesting that government measures to revive the sector may be taking effect. For more than 3 years, China's real estate market has struggled with a downturn that has significantly impacted the broader economy. Regular viewers will be very familiar with this, of course. Policymakers have been working to establish a firmer footing for the sector, as a sustained recovery in transactions is essential for stabilizing home prices, according to Fitch Ratings. Market participants are now looking to this week's National People's Congress, where key economic policies, including growth targets and budgetary measures, will be announced. The second area to note is that China's manufacturing sector showed signs of improvement in February, with the Caixin Manufacturing Purchasing Managers Index, PMI, rising to 50.8 from 50.1 in January. This marks the 5th consecutive month the index has stayed above 50, the threshold indicating expansion. According to S&P Global, both production and new orders reached their highest levels in 3 months, while export orders rebounded, ending a 2-month decline. This aligns with China's official PMI, which also returned to expansionary territory at 50.2 in February, up from 49.1 in January. Economist Zi Chunhuang of Capital Economics noted that the uptick in export orders suggests stronger external demand, potentially fueled by US importers preempting higher tariffs. If this is the case, then this will likely be short-lived, as the new US tariffs kicked in today. Economist Wang Zhe of Caixin Insight Group, behind the Caixin PMI, warned that uncertainties in employment and household income could hinder domestic demand, posing challenges to economic stability. Next up, we have two more developments to cover, but just quickly, recently subscribers have told me that they have been unsubscribed. If you think you should be subscribed, it may be worth checking this now. If you're getting some value from today's episode, don't forget to hit the like button. If you haven't subscribed yet and you think you'd watch another one of these episodes, maybe consider subscribing. And Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. Thank you so much. And next up, China's securities regulator has intensified its scrutiny of small-cap Chinese companies seeking to list on US stock exchanges, following concerns over price manipulation that have led to significant investor losses. The China Securities Regulatory Commission has slowed the approval rate of US IPOs, signaling a broader effort to curb financial exposure to American markets. Since mid-2024, only 11 Chinese companies have received approval for US listings, compared to 22 in the first half of the year. According to sources familiar with the matter, the CSRC is imposing stricter requirements on firms with weak financials, questioning their need for offshore fundraising. This move aligns with China's broader regulatory tightening on overseas capital raising, which has been in effect since 2021 due to new cross-border cybersecurity and data security laws. A surge in Chinese IPOs in the US last year amid declining domestic listings raised alarms about stock manipulation. Many of these smaller firms experienced extreme price volatility, triggering scrutiny from both US and Chinese regulators. A prominent example was Magic Empire Global, a Hong Kong brokerage whose stock price soared 60 times its IPO price before collapsing 95% within a week. Nasdaq subsequently suspended listings of several small Chinese firms, and US regulators, including the Securities and Exchange Commission, SEC, have repeatedly warned investors about pump and dump schemes. A recent study by Hindenburg Research found that 128 Chinese companies exhibited irregular price activity following their US IPOs since 2022, reinforcing concerns about market manipulation. The Financial Industry Regulatory Authority, FINRA, has also observed that such schemes can persist well beyond the IPO stage. To combat these issues, the CSRC has doubled the review time for US listing applications, particularly for firms seeking to raise less than $10 million. Meanwhile, China is encouraging large cap companies to pursue secondary listings in Hong Kong, potentially reviving the city's capital markets with deals worth an estimated $20 billion in 2025. With geopolitical tensions rising and financial oversight tightening, China's shift away from US capital markets appears to be a strategic decision aimed at minimizing risks or consolidating domestic financial stability. And finally for today, we move to the ongoing chip war, one of the many fronts in the US-China geopolitical contest. Taiwan Semiconductor Manufacturing Co., TSMC, is set to invest at least $100 billion in US-based chip plants, reinforcing its strategic alliance with the Trump administration. This significant move, announced at the White House by TSMC's chief executive C.C. Wei, alongside President Trump, highlights Taiwan's commitment to strengthening ties with the United States and securing its position as a key player in global semiconductor production. The investment will primarily expand TSMC's Arizona operations, including 3 new chip fabrication plants, 2 chip packaging facilities, and a research and development center. This expansion aligns with U.S. efforts to bolster domestic semiconductor manufacturing, reducing reliance on foreign supply chains and mitigating national security concerns associated with the industry. Meanwhile, the United States continues to enforce stringent export controls on advanced semiconductor technologies. Recent reports indicate that NVIDIA's latest AI chips, which are officially banned from export to China, are reaching Chinese buyers through third countries. The US-based Wall Street Journal, in a new report published this week, details how Chinese technology firms are acquiring NVIDIA's most advanced systems via intermediaries in Malaysia, Vietnam, and Taiwan. Vendors in Shenzhen have reportedly secured millions in orders for these AI chips, circumventing US restrictions through offshore entities. Indeed, in a report published this week, Chinese financial media outlet Caixin writes, quote, ByteDance is expanding aggressively. Several industry sources told Caixin that the parent company of TikTok recently acquired 100,000 modified NVIDIA chips from Chinese suppliers. ByteDance has denied these claims. End quote. As Chinese firms including Alibaba, Tencent, and ByteDance ramp up orders for Nvidia's H20 chips, one of the most powerful still available for export, concerns are mounting that further restrictions could soon be imposed. The Trump administration's stance on semiconductor controls remains complex. While tariffs on Chinese goods continue to increase, as we just saw, the enforcement of export bans on crucial chip technology appears inconsistent. This raises questions about the administration's broader trade strategy, particularly as it seeks to balance economic interests with national security. On this question, veteran China analyst Bill Bishop observed today, quote, "If the Trump administration takes further steps on semiconductor export controls, perhaps they should request Taiwan recall all its engineers working in the PRC for SMIC and other chip firms." End quote. On this theme, amid growing concerns over illicit semiconductor sales, Singaporean authorities have launched an investigation into potential fraud involving Nvidia AI chip shipments. Law Minister K. Shanmugam disclosed that authorities are probing whether Dell Technologies and Super Microcomputer Services containing Nvidia chips were rerouted to China via Malaysia, violating US trade sanctions. Reports indicate that individuals involved in the scheme misled service suppliers regarding the final destination of the chips, prompting arrests and heightened scrutiny. This case underscores the growing role of intermediaries in evading US export controls, reinforcing the need for stricter monitoring of global semiconductor supply chains. As geopolitical and economic stakes rise, the battle over semiconductor supremacy continues, with China doing all it can and spending tremendous resources in closing the gap between it and the US. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you all tomorrow.